Welcome back to Real Estate Real Talk. I'm Yogi Dewar, and I'm sitting here with Mary Wester. Mary is the president of the Real Estate Investors of Nashville. Our call-in number is 737-7587. If you have a question for either of us on this topic or anything else, please feel free to call in, and we'll give it a shot. We're talking about the Real Estate Investors of Nashville. Nashville, of course, is exploding with growth. This is putting a real challenge on rental properties and developing new housing for people. And a lot of the folks who are players in this field congregate around this organization. It is nearly 500 people now.
Almost 500.
And offers a lot of educational classes and a lot of networking. Is there a website that people can go to?
Yes, it's www.reintn.org. And if you go to that website, you will see that there's a free book. And all you have to do is click on that, and it's on the home page. It's great. The title of the book is How to Get Rich in Tennessee Real Estate. And it's a very thick book, and I've tried reading it. It's not an easy thing, but it is a Bible, and it's great for people who are new to real estate, and even those that are learning about real estate middle of the road.
Yeah, great resource, and I think a lot of the calls that we get in here, a lot of those answers might be there.
They would be.
Something good to check out. Well, we were going to get into financing. Real estate's expensive. One of the great things about real estate is that you can use leverage or someone else's money to help you acquire some of the properties. So financing becomes paramount. In fact, we've quite often talked that we are actually professional borrowers in that we have to set our lives up in such a way that we can be sure to get the money that we need to get the projects we need to get done. And there's a lot of different formats of financing for real estate, and that's what we wanted to cover now. I think first of all, one of the best is probably owner financing, and you've done some of that, I believe. But what does the group talk about there? And let's talk about that a little.
I actually have done an owner financing situation.
Explain what that is first.
Okay. Basically, it's where you buy the property from the seller, and the seller decides to carry the mortgage. And so you don't go to the bank for that. And there's different ways to structure that. In my case, we did something called what was called a land contract, or an installment sale, where the new owner pays me monthly, and we set it for a time period of 30 years, just like the bank would have, and we calculated what that mortgage would be, what the monthly payment would be, taxes and insurance.
Okay, so in that case, if someone has previous credit issues or maybe doesn't have enough down payment to match what a conventional mortgage would look like, they can go to you and just sort of work out a deal.
Typically, they can do that. You have to be the owner of the property to do that. You can't go out and do it for somebody else because of the mortgage consumer protection laws, such as the Dodd-Frank law, the Dodd-Frank Act. But if you own this property, maybe it's something you lived in, or maybe it's something your parents lived in and you own it. That's the situation where you could then do some kind of creative owner financing. In this case, the people wanted to sell their house, and they wanted to buy this condo, but they didn't have enough down payment to, and they weren't getting any money out of their house at the time because the market was depressed in that city. And it still is to some extent, and so they didn't have enough money to come up with it, and they didn't have enough money to pay the bank closing costs. Yeah,
a lot cheaper to get into. But the key component here is, if you are going to be the owner financer, you need to own that house outright, free and clear. There can be no mortgage on it. And then you have the right to sell it to somebody over time. We had an instance at the bank recently where somebody just decided to convey the house to somebody else and hold the note for them. But that's our house. You can't do that. And so that will work itself out. So if you own the house, if you are looking to buy something and you find out somebody has inherited, they've paid off their house or whatever, it is also a good idea for the person selling the house. There may be some tax advantages to them. Can you cover that?
Right. There's some depreciation. There's some write-offs. And it also, if there is a large capital gain in there, that is taken over a period of time and may not affect your taxes drastically.
So if you sold the house and you had to pay capital gains tax in that very scenario, instead of paying it all at once, you could spread it across several years.
Right. One of the things that with owner financing these days, if they don't have enough money to put down, they can sometimes rent the house for a year or 2 years and do what is called a lease with an option.
Right.
And there are other contracts out there that violate the Dodd-Frank law, the new Dodd-Frank Act. But if it is a lease and you can build up credits, rent credits for paying on time, you're building up a credit history at the same time, and then at the end of that 1 or 2 year period, you have the ability to have your credit repaired if you're working on it, and maybe be able to go to a bank and get
Right.
the money from the bank, and then you can pay the bank for the rest of the time period.
Yeah, refinance it, because in that case you can show that you have been making payments and payments on time. Had one come across my desk this last week, $1,200 payment, $700 of it was going towards the purchase price of the property, which was a pretty good deal.
That is a very good deal. That's not common. Usually it's about $200 or $300 max on a $1,200 monthly rent.
Now that I think about it, it was a REN member, and I'm sure that they picked up on how to structure that deal and talk about the buyer here, how to
Right.
structure that deal appropriately so that it would work out pretty well for them. Is there, someone mentioned foreclosures a while ago, is there special financing for foreclosed properties?
I have run into situations, and they're constantly changing.
Right.
At one time, they didn't have anything for people who are investors, but for homeowners, they have something that's called a 203K loan from FHA, and that will let them borrow money to buy the house. But not only that, right now the rule is up to $35,000 to rehab the property.
That's huge.
It is very huge because a lot of these properties may be stripped down, may be in really bad shape, and those are the ones that you'll get the best deal on. And not only that, but if you're a homeowner, sometimes there's what's called insured escrow, and that's money that the FHA has set aside to give you to repair the house.
Wow. Yeah, they don't want this on their books, so FHA wants to get it off the books. They will help you help them get it off the books, and so there is financing that will, it's essentially you're financing the house, but you're also getting a rehab loan in the middle of it and financing the whole kit and caboodle once it's all said and done. That's
Right.
pretty much how that works.
Right, and it's one loan as opposed to
Two separate
Two
transactions.
separate transactions, and usually a renovation loan would have been at a higher interest rate, or it would have been due much sooner. So this way, FHA is trying to encourage people to do it all at once, recognizing that once that property is improved, the after repair value, the ARV, is going to be much higher.
Right, right. Yeah, sometimes these things are a little rough when you get them, and so you need some money to pump in there. Again, our call-in number, if you'd like to check in and ask a question to Mary or myself, is 737-7587. I will remember that number, 737-7587. Foreclosures, how do most investors go about getting their money to borrow? What do you find to be the most typical thing?
I think mostly they will go to local community banks. They'll start with a bank first. They will start with the big banks, and they're not going to get anywhere with that. But they do find that if they go to the small community banks, they have their own money sometimes to loan, and they're more willing to work with somebody who can show demonstrated ability to pay and where the project meets their numbers.
Yeah, most people are familiar with a traditional mortgage, which you get on your own home. And traditional mortgages, conventional mortgages, you can buy up to a fourplex, I guess, but there's a lot of, if you think it's tough to get a mortgage on your own home, try to get it on a rental property. It's a lot of extra hoops. Now, if you can go through those hoops, if you're a clean borrower, you do get 30-year financing, and you do get a fixed rate, although the rate will be higher, I guess, than if it's on an owner-occupied property.
Right. Will there be a balloon at 5 years? Usually on investor properties, that's what I'm hearing. Some people are not getting a 30-year for 30 years. It's amortized for 30 years, but it'll be called in 5 years,
Yeah.
and they'll have to refinance at that time.
Community banks, sometimes the deals that we cut are they're a little funky. And so to go to a community bank where they are able to understand the transaction, that's helpful. You can be a little creative on the financing side as well.
Okay.
Yeah, and a typical, on the term, a lot of people are curious about this because on rental property, you're collecting rent, but you got to pay it back out to your mortgage. So you want to be sure that typically what people want is to have it be as long as possible. So a conventional mortgage or an FHA, you might get 30 years. If it's a newer property, you might get 25 years from a community bank. But more often, you're going to see a 15 to 20-year term, and the rate may adjust every 3 or 5 years within that term.
Okay. Well, as far as what other things that people look for is they will sometimes go to a mortgage company who has an investor-friendly business that they focus on investors. We have one sponsor in Wren that is like that. Not only do they have represent their mortgage company, but they also have a private pool of funds, and so they are very popular with some of our investors.
I would imagine. People who understand what it is that the investors are doing.
That's right. And then after that, they usually have private money. Somebody wants to invest some money that mom or dad has for them, or maybe somebody, a friend that has some money that wants to take a chance with them, and so they pretty much pull together. But a lot of people just come to Wren to find other people who want to invest in their deals, or they want to create what's called a joint venture. The two of them will get together. One person has the experience as a builder, the other person has the money, and they will joint venture on those deals.
Yeah, and so you can have hard money, which is what you're, private money investing in something, and then you can have an investor and maybe a builder or investor and a rehabber coming in.
That's one way to do it. And retirement funds. There is a way to take retirement funds and put them with a company that does self-directed retirement planning.
Right. So you can invest your IRA in real estate.
You can. And wow, if you're only making 1 or 2%, or it's in the stock market and you don't think that's an appropriate way to invest your retirement funds, there are fairly safe real estate plays that you can do through your IRA.
That's fascinating, because a lot of times that's where people's real money is saved up. So, all right, well, we've talked about financing where you can do traditional financing, community bank financing. Sometimes FHA will have special programs, and even down to hard money. So when we come back, it's hard to believe we've gone through this already, but we're going to wrap up, and we'll be back right after this.